What's up everyone, it's Karthik with Moneyvest. Welcome on board for our market open live stream after a long weekend, and markets are certainly starting us off in the month of December by being down. So we are down a little bit in this pre-market as QQQs are down over 90 basis points, so almost 1%. We got the S&P 500 down over 65 basis points as Nvidia also drops over 1% and Tesla is down over 1.4%. as well. Volatility is back a little bit, up over 11% right now. It's back in the 18s, and we got Bitcoin nosediving once again down to $86,000 as Ethereum also now trading at under $3,000 as well. So both BMNR and BITX are absolutely getting crushed pre-market. BMNR is down over 7.7%, and BITX is down almost 11% right now. So crypto sell-off resumes as it continues to tank, and of course sell off very aggressively. So Bitcoin, Ethereum fell sharply on Monday as a recent sell-off in cryptocurrencies resumed. Bitcoin was last seen around 85,000 and Ethereum trading at just under 2,900 here. Solana dropping over 7%, last trading at $127, while other cryptocurrencies also selling off very aggressively. This was Ben Emmons, founder, CIO, FedWatch Advisors, said the people remain nervous following a recent Bitcoin sell-off, adding that Monday's reversal has broadly been attributed to $400 million worth of exchange liquidations and with an estimated $787 billion of outstanding leverage in perpetual crypto futures against some $135 billion outstanding in ETFs. You can do the math. There is a lot of leverage, a sizable leverage still sitting in Bitcoin exchanges, which is upwards of 200 times in some instances as well. So there is still a lot of leverage in Bitcoin out there. We can expect to see some more of these liquidations if Bitcoin prices don't get off the lows from here. And it is predominantly retail driven. That's the worrying part because retail reacts very differently than institutional investors. And that is something to reckon with going forward from here as more and more leverage is used in this space. So if you're part of this community, if you're watching our videos consistently over the last several weeks and months, you guys know that we do not operate with leverage. We do not take on margin. We do not use any kind of debt to buy stocks or crypto. It is very important to always understand that because of the volatile nature of these assets, and as a result, leverage can certainly completely make or break your investment. So as a result, we avoid leverage at all cost. Good morning, everybody. Thank you so much for joining. It's been a long weekend of, it's just one of those memes again of Narcos as we are just waiting for the markets to open, and here we are. December is getting started. I did a full video of going over everything to look forward to December. We also do have a lot of economic reports. So there's going to be a lot of data coming out from the BLS, a lot of delayed data. So from 2 months ago or a month ago. And then we also have a lot of central bank meetings, the Bank of England, Switzerland, Central Bank, the Federal Reserve in the US, all of them, the ECB, all of them are going to be meeting. And the probabilities are very high that we're going to see a rate cut in the US, as well as the Bank of England. ECB is expected to keep rates steady. So a lot of quantitative easing is going to be coming in for this market. So we're going to find out how December does. But November, of course, we just eked out a gain. Very small gain eked out by this market after a very sharp reversal from earlier in the month as we were selling off. So good morning, Moneyvestors. Hope everyone had a great weekend. Good audio for now. Perfect. What is my opinion on BITO long term? We'll take a look at that here in just a minute. Which cybersecurity ETF you would recommend? So one of the ones that we have in our shopping list is CIBR. That's a cybersecurity ETF. It's been consolidating sideways a little bit, but this ETF does have a lot of really high quality companies, including the likes of Palo Alto, CrowdStrike, Zscaler, Fortinet, Okta, Ping Identity. A lot of them are part of this ETF that I really do like. So from its lows of 2022 December, this ETF is up over 106%. Now look, nothing crazy, but I do think that cybersecurity is still in the early stages, and this is going to be a big sector moving forward, along with semiconductors. If there's like 2 or 3 sectors that I'm really bullish on for the long term, semiconductors, cybersecurity, and robotics are 3 that I am very bullish on, of course, along with data centers and cloud computing. So those are 4 to 5 next generation themes for technology and for the entire world, in my opinion, moving forward. Semis have already been doing well. Cybersecurity has been pushing higher as well. But the next big wave is going to be cloud computing, robotics, as well as data centers, which are also rapidly rising. So all, in my opinion, those 3 to 4 are the ones to look at. Coming over to BITO. So what is this exactly? So we got ProShares, Bitcoin. So in terms of opinion, my opinion is the same as it is for Bitcoin. If you believe in it, if you feel like Bitcoin has any kind of intrinsic value, long-term there is potential, then yes, BITO is a good way to own Bitcoin. Obviously it's a derivative because as Bitcoin is trading, so will BITO. I own BITX because it's a little bit more leveraged, but for any crypto position, and this is something that I really want to mention very carefully, and I want you to certainly put this into practice, is with any crypto position, make sure you can only bite what you can chew. That's it. And what that means is you only put the amount of capital into crypto that you can afford to lose. If that number went down to 0, your life would not change. You would be fine. You can sleep at night and you will not have issues with your financial well-being. That is my very important message when it comes to crypto because of the fact how aggressively volatile it is. It is not for the faint of heart. It is going to be incredibly risky, especially when you are putting on a derivative on top of a very volatile asset. So that's what BITO is. That's what BITX is because BITX is a leveraged derivative, right? So if Bitcoin drops, BITX is going to go down 2 times, right? So it's a derivative on an already really volatile asset. So what is my percentage allocation in BITX? Less than 2%, max 3% I'm going to stretch it up to, but that's it. If that 2% of my portfolio goes down to 0, it is not going to damage my financial well-being. Yes, it's going to suck. It's going to be unfortunate, but that's where the asymmetry of that trade comes in. If Bitcoin in the future goes up to 500,000 or a million, BITX is going to be up 20 to 40 times. And that asymmetry of risk and reward is what I'm really capitalizing on. If that 2% goes down to 0, that's fine. But if that 2% eventually becomes 40% or 20% of my portfolio, fantastic, right? That's a huge upside for very little downside. And that's exactly what asymmetry is. You want to always make sure you find asymmetric trades where your downside is little and your upside potential is high if the probability for success is low, okay? Asymmetry is very good for when the probability of success is low. When the probability of success is really high, then you're not going to find a perfect asymmetry, but you are going to find a pretty good risk reward. Even then, we want a good risk reward ratio, right? We want something that we're going to, let's say, 2 to 1 or 3 to 1 reward to risk ratio where you're going to make 20% for 10% of the risk, or you're going to make 20% for 5% of the risk. So that's a 4 to 1 reward to risk ratio with a high probability of success. If there is a very low probability of success, and that comes with venture capital, private equity, that comes with crypto, that comes with any startup idea, if it's very new and there is a lack of certainty of where the outcome is going to be, then always start small. Always start small. You can always scale into that position, but you cannot scale out very easily. So that's why I think it's really important for everyone to always remember. It doesn't matter. It can be applied to individual companies. It can be applied to crypto. It can be applied to anything that is volatile, and that is something that you're not kind of sure if this is going to work out or not. If the conviction level is low, always scale in. Always start small, and you can always scale in. So, okay, perfect. Good day, everybody. HIMS upward channel and good idea to start a position in. Let's take a quick look on HIMS and hers here. So HIMS starting to show some signs of strength. We are pushing higher from that level of support of $33, $34, but it is coming up to that resistance. So this right here is going to be that resistance to watch for HIMS. So we are getting a little bit of that resistance and that rejection there. Support level at $34, $35. If you do get a breakout above this, next target all the way up to $47, $48 for HIMS. Okay, can you please give your thoughts on BUG? I think it's another ETF, right? The bug ETF. Yeah, cybersecurity. And look, we can analyze it together. So if you can come up to etfdb.com, I've mentioned this many times before. You can simply come over here, analyze whatever ETF it is that you want to analyze. Pretty good source on, going over all the different holdings, concentration, geography, all that stuff. So looking at BUG, Global X Cybersecurity ETF, the couple things that I really want to mention when I'm analyzing ETFs are the issuer, right? Who's the issuer? Which company is actually issuing this ETF? The second thing is the expense ratio, right? What are they charging per year? The third is liquidity. So is the ETF actually traded in decent quantities, right? So the volume pretty good. So that creates liquidity, because if you don't have liquidity, then you're going to have issues getting in and out, right? So that's not what we want. And then assets under management, right? How big is the ETF? Like, are people actually buying this, or if this is something really, really small from a issuer that we've never heard of? So in this case, we got Myra, Asset Global X is the brand, 0.5% in expense ratio, which is pretty standard for an actively managed, thematic, specific theme ETF, which is in this case cybersecurity. Next thing we're going to look at is the holdings. So holdings are, again, some of your big names. We got Fortinet, CrowdStrike, we got Zscaler, we got Palo Alto Network, we got SentinelOne, we got Qualys, Rubrik, Okta. I don't find CrowdStrike. CrowdStrike's over there, but then I don't find Palo Alto is there, Zscaler is there. Okay, so the big ones are there, and then Checkpoint Software, Akamai Technologies, CyberArk Software. So all the big ones, right? So this is all good. And then if you come over to BUG, volume is low, right? So this is why I mentioned liquidity is really important, because volume is only 260,000 shares traded on an average 30-day basis. So that's not what we want, because liquidity is going to be an issue. If you come over to the 1 minute, 5 minute chart, you're going to see a lot of breakage and wider spreads for a stock or for an ETF like this. You can see the candles are not well formed because of the lack of liquidity. If you compare this to, let's say, CIBR, I think it might be a little bit better. So 739,000 is the volume, average daily volume. So we're talking 3 times more, with assets under management at almost 11 billion, right? So 11 billion versus, if you come over to BUG, you're looking at less than $1 billion, right? So 988 million. So it's 10 times bigger. And then if you look at the expense ratio, and this is also issued by First Trust, which I believe to be a much better issuer than BUG's issuer. And it's almost the same, right? 51 or 59 basis points. And then if you come over to holdings, it's going to be the same. In fact, it's got a higher quality of companies. I would argue it's got Broadcom in there as one of its biggest holdings, CrowdStrike, Cisco, Infosys, Palo Alto, Fortinet, Zscaler, all those companies, right? So some of them are overlapping as well, but I do prefer CIBR over BUG. Just my 2 cents there on those two. Okay, is it a time to nibble on Oracle? Let's take a quick look. Oracle has been selling off as well. I do believe that this is a pretty good opportunity to dollar cost average a little bit into this stock, given how much it's been selling off. It's trading right at that support perfectly. It's very oversold on the weekly time frame. See the RSI, the MACD, L3 banker oscillator, everything has been selling off aggressively. Of course, we got a very, very good support sitting right inside this green rectangle at about $180 to $200 per share for Oracle there. All right, so Bitcoin crypto, do you have or carry a wallet, or just concentrate on ETF? ETFs only, but if you are going to be looking at direct wallets, I would mention cold wallets or hard wallets, so to speak, things that are off the servers, off the online web, basically. So having a hard wallet, I would argue, is better, safer, because you've got full control over the custody of your coins, as opposed to obviously using an online exchange. Okay, let's see. Are you looking at iron? Yep. So I do have iron, a little bit, not a lot, but I've been obviously analyzing this stock for quite some time, 5.5% down pre-market. Everything's been selling off pre-market right now. Support level is going to stay put at $39.50 to as much as $40. And a resistance right now stays put right about here at $49 to $50 per share. Finally joined Patreon after such a long time. Well, Mr. Bliss, good, welcome on board. Very, very happy to have you. By the way, we do have our Cyber Monday sale ongoing right now, and today is also the day we're going to be launching our brand new Moneyvest dashboard, web and mobile. So later today, so around 12 or 1 p.m. Eastern in the afternoon, I'm going to make an announcement, and this is going to be live, push to production, and everyone who's going to be signing up or signing back in is going to have access to the brand new UI for our Moneyvest platform. You can access everything. The dashboard is going to be there. The Moneyvest index broken down between S&P and the NASDAQ. You got the macro dashboard, snapshot, concentration, RSI dashboard, bear market, seasonality, earnings calendar, the shopping list, as well as individual stocks as well. You can come over to any stock you want to analyze. And of course, it's going to have its own stock page with the Moneyvest metrics, fundamental analysis, the analyzer tab, looking at different models. If you want to calculate discounted earnings model, you can do the autofill, hit calculate, and it's going to produce this entire beautiful analysis that you can look at and, of course, tweak some of these numbers as well as per your own liking. So we have that as well. And yeah, I think it's going to be great. Excited to hear all the feedback. So far, it's been great from all the early beta testers that we've had. And so that, I think, is going to be great. So all of that is going to be there. You can tweak around. You can pretty much calculate your fair values, intrinsic values, all that on the platform. So yeah, welcome on board. Very, very happy to have you, Mr. Bliss. Okay, I already covered Bitcoin. We covered. My calls are cooked. The occasional detailer says, yeah, markets are pulling back a little bit. So obviously a lot of calls are going to come down in value, which non-leveraged Bitcoin, Ethereum ETFs, again, is good for long-term and selling covered calls. So IBIT is good for Bitcoin, and then ETHE is good for Ethereum. So these are non-leveraged Bitcoin and Ethereum ETFs to consider. Yeah, always start small, then later we ball. Keeping us to 5% each to include silver and gold ETFs. Yes, I also have a little bit of gold and silver, so obviously keeping that to a minimum, something that I can manage. And look, most of your growth is going to come from equities, right? So if you kind of compare stocks versus real estate versus commodities versus crypto, a lot of that, and I'm talking in terms of what is also been tested and proven, right? Stocks have always won out in the long term, although you could argue in certain instances, crypto has given you better returns, but then with what volatility and risk, that is also what we have to factor in, because when we talk about reward or return, we talk not just in terms of, at least not on the channel here, we don't just talk about absolute returns. Absolute returns are a very, very elementary way of talking about returns in general, right? If you're just talking about absolute returns, but we also have to look at the risk and the volatility that comes with those returns. If crypto is swinging 80-90% in a year, it's down 80%, then it rallies 1,000%. It's extremely volatile. And yes, you could argue it's getting a higher rate of return, but at what cost? The cost is the equity and the risk that you have. With stocks, of course, there's still a price movement, right? There's going to be volatility, but significantly less than that of crypto. Real estate on a year-over-year basis is going to be even less volatile than stocks, but then what's going to be that upside, right? We're looking at 3 to 4% appreciation in rental properties or properties in general in real estate, but stocks are purely driven by earnings, and earnings are growing at a faster rate than investor appetite for real estate or people's affordability for real estate. So in my opinion, over the long term, there's no better game than stocks. But then there's always that discussion that there's different strategies within different asset classes that allow you to make higher than average returns, which obviously can be better. So we just have to look for those arbitrage opportunities in those different assets. Okay. Yeah, so commodities I have, real estate I have, stocks I have, and then crypto-wise, it's just a little bit of Bitcoin, BITX. Okay, what do you think about Japan raising rates and results on the U.S. bonds and possibly the overall market? What are your thoughts? I think it's been pretty known that we're going to get the interest rate hikes in Japan. So if you look at the 10-year treasuries, they've been pushing up, right? So from 1.87% right now, so they're up almost 4%, hitting probably a multi-decade high. So we're looking at levels that we haven't seen since 2008, right? So, but it's been trending upwards for a long time. And so it is not new news. It is something that we have already been pricing in, that interest rates in Japan are going to be rising. So I don't see this as a huge catalyst for the U.S. markets, although yes, it's going to be affecting the U.S. market and investors' appetite for fixed income, for bonds in general. But 2025 has been so far very, very strong, right? We're up 16%. I think this year we're going to close out in the double digits. 2026, though, I'm not very bullish. I'm not super confident. I am optimistic, but I think it's going to be quite an interesting year with plenty of opportunities, and that's exactly what I'm preparing for. I think this month I'm going to just be preparing for 2026. I'm going to be sharing all my plans with everybody on Discord. So that's going to be the path forward, is just preparation this month, next month, because I not really know, but I can always sort of sense that 2026 we will get some very good opportunities that we don't want to miss out on. And if the Moneyvest index is down at 2 or low, like below 2, and we've got the volatility really high, I think that's going to create some very interesting, very, very lucrative opportunities. Okay. Didn't expect Santa will start the downhill. Yeah, I know, right? December starting us off on a downhill. CSB on SoFi, $26 expiring on Friday. Should I just let it run or try to close early for 90% profit? 90% profit all day. If you're up over 85, 90% on any option, puts or calls, it's worth taking the profit. If you've got anything more than a couple days left, I think it's worth taking the profit and rinsing and repeating the process. If it's like less than a day, less than 2 days, sure, you can make an argument to capture that additional 10%. But if it's anything more than 2 to 3 days and you're up already 90%, then might as well just take profit, release the collateral, and you can use that collateral to write another option. Do you like Meta at these levels? I love Meta at these levels. Been picking up a little bit in the 580s, 590s. Well, my orders have been getting filled at 590s. I know a lot of our members' orders have been literally pinpointing down to 580s, which is good. But yes, I do like Meta. Is it a good risk-reward ratio to open a new position in Palantir? Thank you, Caddy. So depends on the size and scale of that position. If you are like, okay, I want my portfolio to have 5% Palantir, for example. You're like, okay, I want to allocate 5% to Palantir. And you're like, okay, I'm just going to buy a little bit. I'm just going to start with 1/10 of my position. I'm going to buy 0.5% here, just as a starter position. Given that it's already down a little bit over 20%, it's in a bear market, I'm going to start small. That's okay. But of course, allocating everything at these prices, probably not. If you come over to the shopping list, Palantir still has pretty low light buy, right? So buy targets are still very low. We're looking at $80, $60, $50, like that. Those are the buy targets, right? Given how expensive this stock is. And so my strategy has always been to try to get my cost basis as close to my fair values and light buys as possible. That's been the game since day one for me. So if you'll notice, Tesla's 200 light buy, heavy buy is 185. My target is always to get my cost basis somewhere in between those numbers, and also considering the fair value at 151. So like somewhere between 150 and 200 is where I want to be for Tesla. Another example I can give you is for SoFi. If you scroll down SoFi, we've got it at $17. My cost base is around 18. So again, that's really where I want to be. I want to structure my plan in a way where my cost basis sits right where my light buy or heavy buy calculated value is. Now, that doesn't refrain me from buying at high levels, because even if I do buy at high levels, I just want to make sure that I don't dent my cost basis too much, that it moves up a lot. So if my cost basis on SoFi, for example, is 16, and it's trading at 26, I'm okay buying at 26 a little bit, so much so that it doesn't move my cost basis all the way up to like 25. I don't want to, if I have 100 shares of $16, I don't want to go and buy 1,000 shares at 26 because it's going to move all my cost basis up to $25, right? Because it's a pretty large buy order. If I've got a 500 shares at $16, maybe I'll pick up another 50 at 26, or maybe I'll pick up another, 20 or 30 shares. I'll continue to kind of add a little bit so that it doesn't move my cost basis too much. It's always making sure that your cost basis aligns with your fair value, or at best lower, because that's really where you want to be as an investor. You want to tweak around with those cost bases. So that's why it's not a direct yes or no question. There's always a nuance in dollar cost averaging even and just buying stocks, because we need to have a full picture of where your position is, what percentage allocation you're currently at, what's the cost basis, what's your buy targets, where would you like to be with this position, and that's when you can make a decision on whether to pick up more shares or to just like hold back. So yeah, hopefully that helps a little bit. Excellent breakdown on bug ETF, Mark. Thank you so much. Netflix is approaching an interesting area technically. Yes, Netflix also has been coming down. So we are in this downtrend of lower highs and lower lows. So I agree. I think it makes for a pretty decent swing trade opportunity here inside this green rectangle, and a resistance all the way up to as much as 116, 117, right? So that is going to be that level to watch for Netflix. So a little bit of a downtrending channel, lower highs, lower lows, and that is going to be that resistance there. So, okay. Mobile is a good choice, yes. So web is also going to be available, web and mobile. So you'll be able to access the Moneyvest website on the mobile version as well. So you can pretty much go to moneyvest.com on your phone, and you'll be able to see everything that you normally do on the website. So Moneyvest Index, shopping list, everything you can pretty much access from your phone, which I know is going to be a huge game changer for a lot of people, because I know a lot of our traders, investors just literally do everything from their phone, and they're on the go. They want access to everything from their phone. So that's going to be available after today. So why is the market red today? Well, market doesn't really need a reason to go down. But yes, we are seeing a pretty substantial drop pre-market. NVIDIA also taking a $2 billion stake in Synopsys with expanded computing power partnership. Synopsys is rallying, I think a little bit over 7% last time I checked. S&PS, it's up over 8% now, trading back up to 451. So resistance all the way up to 460. NVIDIA is just throwing money at companies now. That's all it's doing. It's just buying stakes after stakes into businesses, into companies. That's all they're doing, is just buying up small stakes in companies, because they don't really know what to do with all the money they're making. They're just printing capital, more money than they know what to do with. And so support level right now for NVIDIA is going to be 173, 174. We are still in a bit of a downtrend, and resistance all the way up to 183, 184. Being proactive is better than being reactive. Well, I guess if you are preparing, then yes, obviously you want to be proactive. But if you are trading and investing, I think being reactive is better than being proactive, because proactive ends up being a little bit more of a gamble. You're trying to predict what's going to happen as opposed to reacting to what's already happened. As I mentioned before, the opportunities don't lie in predicting. The opportunities lie in the reaction of the market, which is either an overreaction or an underreaction. That's where the arbitrage is, because once the news comes out and the markets react, our job is to analyze the news, tie it back to the market, and understand, did the market appropriately, efficiently price that information in? If not, that's where the opportunity is. That's where it lies. That's the reactionary part of investing. It's not trying to predict what's going to happen, because the beauty of the market is you could know what's going to come out in the data, in the papers, in the media tomorrow, and still not know how the markets are going to react. That's the beauty of the market. And that's why earnings and every single piece of information that comes out is almost impossible to predict how the markets are going to react. I could tell you next quarter, Amazon's going to beat earnings. They're going to guide really well. and you would still not be able to predict how Amazon stock is going to do. Even though you know the earnings, you're like, okay, they know the earnings are going to be a huge beat and we're going to get a nice guidance lift, and still not know how the stock's going to react. That's the beauty of the market. So that's why, that's my quick take on that. Are you going to raise more cash? Yes. So already in the process of raising more cash. We'll continue to kind of buff up the cash position a little bit. And so that's going to be the plan for 2026, is to have slightly extra cash available on the sidelines in case the red mic makes an appearance, which from the red mic gods, I think it will. And if the markets give us those opportunities, then I think it's going to be very, very good. Thanks, Karthik. But could the Japan take their money to invest in Japan instead in U.S. debts? Yes, I mean, that's always been an issue. Obviously, that's one of the bigger concerns. Is Japan, of course, some of the biggest holders of U.S. government debt is Japan, is China, is a lot of those, Asian countries. But I doubt they're going to do that because it'll also be, it's a two-way street, right? For U.S. China, U.S. Japan trades, it's always a two-way street because U.S. is one of the biggest consumer markets. Japanese and of course the Chinese is one of the biggest manufacturing producing markets, and one cannot survive without the other, right? So it's really important for both economies to function well in order for the world and for these countries to do well. So yes, that's always a risk, but markets are nothing but risk. That's what markets are all about. All markets, doesn't matter what markets you're dealing with. Even the bond market has risk. It's not near perfect risk-free. Yes, the farther you go out on the risk curve, the crazier and the more risk we have to deal with, but everything carries risk. So I think a lot of my time is spent into analyzing risk. That's really where a lot of the time is spent, is risk analysis. What are my thoughts on metals? Silver, it has broken the rim of cup and handle chart monthly. Yes, so silver is one of the best performing assets of 2025. It is broken out to 57.50 now per ounce, is doing incredibly well. Year to date, it is now up over 99%. So it's now doubled in value. Silver has. I picked up a bar of silver, I think in February. It was earlier this year. In fact, I have it with me. It's crazy because I was accumulating a lot of gold and silver, right? Not a lot, but again, in relative terms, it's not a lot. But in absolute terms, I was putting a little bit of money into silver and gold. And silver, I'm kind of contemplating now if I want to ring the register a little bit. But I do see it going higher. I do expect silver to get up to over 60 and eventually up to upwards of $100 per ounce here. And gold also has been on a tear this year, although still yet to break out the all-time highs at just over 43.80, almost $4,400 per ounce, and right now it's back up to over 4,200. Making your own silver play button. Yes, I know, right? Look at this. Right here. That's the silver play button. Here we go. The silver play button. Now even more valuable than before. Okay. Do you think metal will break over 636 resistance this week? Let's take a look. I mean, the next resistance, 636 is already broken. 636, we don't really have that as a resistance. The next resistance is closer to 660, and support is now at 635. So, I don't know. I think you're about a week late. This is already broken, or at least a couple days late. NVIDIA, good at 139. So NVIDIA support I have is around 165 first, and then it all the way comes down to 150. So those are the support levels to watch for NVIDIA. Okay, let's see. Hood, when is a good entry? What is the best opportunities in the market right now, in your opinion? We'll come back to that, Kian. It's a pretty loaded question. What are the best opportunities in the market right now? another question, can become your standard thing to cover in each live or in a daily update in Discord? Yes, I agree. I think that's a great question. We can definitely talk more about it. But the thing about this, question is that this doesn't change very often. It's not like we can talk about this every day. Quality opportunities are very far and few between. It's like not every day we can talk about, what's the best opportunity in the market, because there's not that many. But we can definitely talk more about it in more detail. If we did have a red year and you had a stock at $25, would you just DC and sell more puts while the downtrend continues? So if the plan is to accumulate more, then yes, I would just continue to sell more puts on that stock to accumulate more shares. So one of the best ways, in my opinion, to accumulate more shares in a downtrend is by selling puts because you're getting paid to wait. You could also buy straight in the market, but then with selling puts, you're at least collecting a lot of premium along the way. Okay, let's see. No risk, no reward. I agree. For your wedding? No. I don't know why the wedding question keeps coming up. I know I just turned 29, but still, it's a nonstop topic of conversation, I feel. In comments, sometimes I go through the videos of YouTube and they're just like people talking about my wedding. Would you take a leap like this? 2026, 382 days out on SoFi, $30 strike, $755 premium, or is that too far out and too much increased risk? So Rick, I would definitely run this through our leap calculator to better understand if it actually makes sense to even get this leap, or you're better off just buying the shares. Because if you're looking at, let's say, 382 days out, so December 18th, $30, you mentioned, I'm going to assume you said $730. So like, what is it? You said $755, right? So $755, I'm not sure if that is going to be accurate. Let the markets open and then see what that premium is going to look like. Actually, you know what? It might be, because it's not in the money. It's out of the money call. So it's not necessarily a leap. A leap would be somewhat in the money, deep in the money, 1 year out call. But this, again, as the price increases, you're dealing with a delta of about 64. So for every $1 increase in the price of the stock, options goes up 64 cents, which again is a positive delta. You're going to increase in value as the stock goes up. But then for me, I do prefer buying in the money, deep in the money leap options. Like, for example, the $15 call, because it does provide a very high delta correlation with the underlying stock. Okay, what are the best opportunities in the market right now, in your opinion? So I think the biggest themes for the next several years that I'm focusing on, as I mentioned earlier in the live stream, semiconductors, cybersecurity, robotics, cloud computing, data centers, right? Those are the 5 that I think are going to be huge over the next decade. These are the 5 that you really want to be in if you want to make, just massive returns, because this is where technology is headed, right? Semiconductors, SMH, cybersecurity, a lot of individual stocks, and their cloud computing, data centers. We already know some of the hyperscalers, and then of course we got chip companies, semiconductor companies, and then robotics is going to be Tesla. Nvidia is working on it, and then Palantir also with artificial intelligence and data. So those remain some of the biggest themes, in my opinion, for the long term. And there's going to be new entrants in these spaces, and that's what we have to analyze on a case-by-case basis for individual stocks. If there's going to be new companies, small cap, mid cap stocks disrupting these specific industries, like for example, iron started off as a data center, then crypto mining, and now doing both of them on the back of renewable energy, right? Got a very, very strong defensible moat. So iron, in my opinion, has a huge potential long term, as long as there is a massive demand for cloud computing and for data servers, right? Data centers. As soon as the demand starts to kind of balance out the supply starts to outstrip demand, that's where we're going to see that stabilization in a lot of these hyperscalers and a lot of these companies that are running on this massive momentum. But that, companies that are very much willing to pivot and quickly pivot are the ones going to survive for the long term. As mentioned in my previous live stream from last week, this is a very, very rapidly evolving and changing landscape. Companies are getting disrupted. Workforce is getting displaced. We're seeing technology evolve very rapidly, right? And I think the companies that are going to adapt are the ones that are going to survive. Could be any company, right? Companies that we haven't even heard of yet. So that's why management, the three moats that I talk about, right? The total market, how big is the market, how defensible is the moat, and the third most important one is the management. If you don't have the management adapting to the changes, like I believe Alex Karp, Elon Musk, and Mark Zuckerberg are people that are like super aware the technology is going. Jensen Huang. So management is going to be so much more important than the company itself, because you could have an okay company turn into a great company. Like, for example, Iron is a prime example of that. It was nowhere on the map up until April, and it just took off on the back of this huge pivot from the company. So companies that are willing to adapt are the ones going to survive long term, even more so now than ever before. Okay, if you want to own 500 shares of a stock, start DCing around 25 till you build up 300 shares and then sell 2 CSPs puts. That would be a great way to play it. You can construct it any way you want. Yes, I agree. I think it's really important to kind of scale in and dollar cost average slowly to those positions. Oracle is a great risk to reward, and I might be a year out leap call with 215 strike price. Thoughts? I think I like Oracle leap, given how oversold it is. And if you do see any kind of a bounce and technical rebound here, those leaps are going to print. So I like those. Just be mindful that, again, I don't necessarily like buying options. I mostly like selling options. So if I were playing this, I would be playing it from a sell put perspective instead of a buy call perspective. But to each their own in terms of their risk tolerance and their strategy. All right, everyone. So market's going to open in about a minute here. Hope you all are ready for this open. We seem to be pulling back quite a bit right now. So QQQ is down about almost 1%. We got the S&P 500 down 67 basis points. NVIDIA, Tesla, SoFi, Palantir, everything pulling back with the VIX that is up over 10% right now. Here we go. Markets are open. December 2025 is upon us. Last month of the year. And we are ready to close. Hopefully strong. We'll see how the markets trade in the next 20 plus days. But so far, year to date, the S&P 500 is still up very nicely, up 15%, 16%. I did the analysis for the last 50 plus years, how many times we've seen the markets up over 10% or more, 3 years in a row, only 3 instances, and only once where we went to a 4th year, which was 1990s. The last couple of times, the markets broke that streak in the 4th year by going down. Thank you so much, everyone, for joining. Really appreciate you all. Again, drop a like and subscribe if you haven't already. The new website, the new launch goes into production, goes live later today in the next 3 to 4 hours. Again, link's going to be down below if you're interested in joining for Cyber Monday. Tonight is the last day if you want to take advantage of this 40% discount, and it does expire at midnight tonight. Any questions, admin@moneyvest.com is my email. Just send me an email, and I'm more than happy to schedule a call with you to kind of walk you through the entire process and everything that we have to offer. As always, happy investing. I'll see you all in the next